Hello, investors and future investors. Welcome back to the channel. My name is Tim, and on this channel, I show you how I use my portfolio in order to generate weekly income. For today's video, I'm going to show you how to use options rolling to increase the amount of money you receive or to get out of an option that's going against you. Welcome to Investment Gains. Let's jump right into it. So, welcome back, investors and future investors. Now, option rolling is something you must learn if you decide to trade options. One of the first rules of option is that you should always have an exit strategy before getting into any trade. That being said, for today's video, I'm going to be using my Palantir option that I already have. So let's go ahead. We're going to scroll down and I'm going to explain the trade to you. So I have one contract with Palantir that expires on this current Friday, which is going to be the 6th of September. Now, I sold a covered call in order to receive this premium, and the premium I received was 30 cents or $30. Currently, I am up on the option and up around 70%, and that equals to $21. So I do not have to roll this option if I don't want to. However, this is just for purposes of making this video. I'm going to show you how to roll an option if you need to roll an option anytime in the future. Now, also, if I were to close this strategy right now, I would have to pay 9 cents in order to close that out. So what's going to end up happening is that my total return on this current sell call is going to be $21, which is going to be the $30 minus the 9 cents I'm going to pay to close it. Hopefully you guys understand that because you need to remember all of this for the next steps. Now, this is how you roll using Robinhood. If you guys want me to show you how to roll an option using TD Ameritrade, Momo, Webull, Interactive Brokers, anyone, just leave me a comment in the description below. It's pretty much the same thing. Robinhood, however, makes this super easy, super simple. So here we go. So we're gonna go ahead, we're gonna scroll down, and Robinhood has this little thing here that just says simply roll this position. We're gonna go ahead and we're gonna click onto that. Now, Robinhood makes this so simple that there's a couple things you did not see that happened just then. So I'm gonna go ahead, I'm gonna break it down to you. So first of all, my expiration date was the 6th of September. By hitting roll this position, Robinhood automatically shows the next expiration date, which happens to be September 13th, and that represents 9 days out. Again, I did not have to choose that. That was done automatically. The other thing that was done behind the scenes is that Robinhood automatically attempted to close out my position. Whenever you roll in an option, it's most likely a two-leg option strategy or more. So with the first leg, what they went ahead and do was that they already set the amount of price I'm going to pay if I were to close it off right away. So you can see right here, this is my $33 call. And if I were to close this position, I'd have to buy it back. The reason I'll have to buy it back is that initially this was a sell call. Good. So if you move from one strike date to a further strike date, that's going to be called rolling out. Now, rolling out is just the first step in options rolling. So now we're going to go ahead and we're going to continue with the trade. So we already roll out to September 13th and we already have our close position. So now we're going to go ahead and get our second leg. And for that, we have to select a different strike price. Now, the strike price I'm going to be going with is going to be the 33.5% strike price. Now, if I do choose this strike price right here, that's going to give me a high chance of profitability in the 85 percentile. Now, with the $33 strike price and a high chance of profitability, I will be receiving $31. So here you go. So let's say I were to roll this option right now, I would have to pay 9 cents or 10 cents. The stock market is currently open, so this will fluctuate just a tad. So if I were to roll this option right now, you're going to see that it says covered call roll, which means I have a covered call and now I'm rolling it. So the first step would be, which Robinhood automatically chose for me, would be my close position. Then I just close my other sell position, which is going to give me 0.31. Now the difference between these two is going to be my new premium. So my new premium is going to be $21. So hopefully you guys remember my first sell call, I received $30. if I were to go ahead and roll this option now, I would be receiving an additional $21. 21 cents multiplied by 100 shares, and I get additional money just for rolling the options. Now, rolling options is a very easy way to either get out of trouble if the trade goes against you, or if you want to make additional premium. Now, there is different types of rolling. What we did there was we rolled out and then we also rolled up. Now, rolling up means just going to a higher strike price than what you previously had. So we rolled out, then we rolled up. Now I'm going to show you another way you could roll. So let's unselect this. And this time we're going to go ahead and we're going to choose a strike price below our current covered call. Remember, my initial covered call, as you can see here, was $33. So I'm going to get a strike price below that. I'm going to be going with a 32.5 strike price. Now, with the 32.5 strike price, now I have a reduced chance of profitability. It's still pretty high. So it's around 79%, which works fine for me. Everyone has their own preference. When trading certain option strategies, my preferred preference is always a 80% chance or higher. 79 is pretty close, so I will accept that. Now, if I were to choose the 32.5 strike price, and it will get a chance of almost 80% chance of profitability, I will be paid 0.52 or $52. Once again, each option contract has 100 shares. So you multiply 52 cents by 100, that's going to give you $52. Now, this is called rolling out and then rolling down. We rolled out because we moved from September 6th to September 13th. We rolled down because now we choose a strike price that's below our initial covered call. As you can see here, once again, it says covered call roll once again. Now, if you notice, I will be receiving a lot higher premium, but why is that? The reason I'm going to be receiving a lot higher premium is because my chance of profitability has reduced. So with higher risk comes higher reward. It's just that simple. Now, once again, the total credit I'm going to be received is going to be added to the initial $30 I received. So on one stock in 2 weeks, I will be receiving $42 plus $30, which is $72. All you need to do now is divide $72 divided by the total cost of the Palantir shares, and that's going to give you your percentage return. Without doing the math, this is a pretty decent return. And that is how you roll options. There's two ways. You can either roll out and up or vice versa, roll out and down. They both work and they both can help you save a trade or accumulate additional premium. So thanks for watching. And if you guys have any questions concerning this strategy, leave it in the comments below. Also, if you guys need any help, if you're struggling with making money from options, please let me know. Maybe we are able to help you. The link you're looking for is going to be in the description below. Now, until the next video, keep pushing your investments. And remember, right before you go, there should be two videos appearing right now. Feel free to click any one of them in order to continue being part of the weekly income team.